what you remember from last week. So, right, I'm talking about finance and different sources of finance, and so you can tell me what you have remembered.
Okay, different sources of finance, or it can be shares, bonds, debentures, same thing. What else? Personal funds, credit unions. What else did we talk about? What else? I don't know if Jaren is. No, I don't think Jaren is a source per se. But yeah.
During?
Yeah. Isn't it a long-term loan?
Oh, okay, yeah. Yes, definitely. Yeah. Yeah. We also spoke about venture capital as well.
Yeah.
Yeah.
I want. Okay.
Pardon me? I didn't hear you.
I was going to ask. I was just asking if you wanted me to explain that too, but then you move on. So.
Yeah. Yeah, you can.
Oh, it's basically it's about wealthy investors looking at the potential of your business. If it's one that could possibly be successful, they would invest in your business.
Oh, yes. All right. So this is the question that I was asking you to do. But as you said, don't worry, we'll go through it today, right? I know that you haven't yet done investment at school. However,
I actually did.
Oh, really? Oh, really? Okay. All right. So even if you haven't done it personally, this question, you can let me or tell me how you would do the first question, how you would get the cumulative cash flow for each. For recording purposes, I'm just going to, okay, so in this session, we have to choose which project gives us our money back or the best cash flow within a certain period, right? So that is how we would that is just what we're doing today for recording purposes, right? So you can contemplate on it. I'll give you a few minutes to do so, right?
What exactly do you want me to do again?
So we're doing question A.
Yeah.
So we, if you remember how the cumulative cash flow is calculated, do you remember that, or
Isn't that you add over time?
Subtract.
Subtract.
Yeah. So remember, we are we are investing in, we have 3 potential projects that we seek to invest in, right? And you know that in every single investment, we not only seek to get our money back, right? But not only get our money back, but we also seek to make a profit. But the profit part, we're not talking about no. It is only what we're trying to get back the original investment that we've made over a period of time. So we just want to know exactly how long that it will take for us to get back our original investment, right? And these and if you see here 1, 2, 3, 4, and 5, they suggest the number of years, right? And these, as you see here, are the different cash flows that are generated within that year, within that second year, and etc. Right?
Yeah.
Right. So, okay. So, yes. All right. So I guess that we can go to the actual answer, right? Okay. So yes. So now you see the 40,000 that we have invested into project A, project B, project C. Sorry, potential. We haven't yet invested, but we just want to know exactly which project would be best. So for project A, right, and this is the and CF stands for cash flow, right? And so just take note of that. And so we have a 40,000 here, right? And so in year one we would actually okay in a year one we get back $12,000, and so we would subtract the 12,000
from the 40.
yes from the 40,000, so that we would know exactly how much more we have to retrieve, right? And so, right, exactly. And so then we would go down the line, and so in the second year we would get the 12,200, and so we would subtract the 12,000, right, from the 28,000, and that we have left back to retrieve, right? And so we would get 15,800 left to retrieve, right?
Yeah.
And so we would do it like that until but you see, right, that even though we have 4,000, we have accumulated the cash flow for a year 3 is 11,800, right? But we would see, right, that and that when we subtract when we subtract the 15,800 from the 11,800, we would get back the 4,000. All right, and so the next year's cash flow is going to be, it is actually a way more than what we actually have to retrieve, right? So what we would do is that we would actually...
You're breaking up.
Oh, okay, I'm breaking up. Okay. What was the last part that you heard? Am I still breaking up?
No, you're not breaking up anymore.
Okay. All right.
Last thing I heard was about the 28,000, and you would subtract the 12,200 from it.
Okay, right. So when you subtract the both of these, you would get the 5,800, right? And then you would keep on subtracting the next cash flow from the remaining, and that you from the 15,800. And so you would have 4,000 left to retrieve, right? But in the next cash flow, we see that the 4,800 is way more than the 400 and that we have left to retrieve, right? And so then in order to get back how much time, how much, okay, let me rephrase this. In order to get how much the 400 is within this for 40,200, we would have to divide, right? Because it isn't the full it isn't the full 14,200 and that we want, and so we would divide the 4,000, since this is still up. Let's see if you can. All right. Okay, right. All right, so we would actually divide it like this, right? Can you see my screen?
Yeah.
Right. So we would divide it like this in order to get the 0.28169 months, right? And that it would take to retrieve that 4,000, right? And so can you figure out how much years in all it would take to retrieve the full 40,000?
You should look at the cumulative for that, right?
Yeah. Yeah, I look at this part. Yeah. All right. Okay.
But if I add if I add the 28,000 to the 15,800, that would give me more than the 40,000.
Okay. We're not trying to. Okay. Remember that this here is the years, right?
Yeah.
We're not trying to add anything to the 40,000, right? We're just trying to see exactly within this time frame right here, how long would it take for us to get back the 40,000, right? And so remembered that when we were subtracting the 40,000 from each cash flow, right, it would stipulate the year as well, and that it would take to get back such. Right? Are you understanding, or?
Can you go again, please?
Okay, no problem. All right. So, remember and that the cash flows are right here, and that I have highlighted. These indicate the different years, right? And so for year 1, you would get a cash flow of 12,000, right? And so remember I said, right, and that in year 3 you have $4,000 remaining to retrieve from the 40,000, right? But remember I said and that you don't need this a full 14,200 in year 4, right? And so when we divide, when we say 4,000 into 14,200, that would give us a portion of the year that it takes to retrieve the entire 40,000. Right? So for example, right? Okay, actually no. This is the answer, right? So it took 3 full years to retrieve the 30 okay, right, at the 36 years, sorry, the $36,000, and then it took a portion of year 4, and it took like 2.8169 years, sorry, 3.3 of the 3 full years plus the 0.28169 years to retrieve the $4,000, right? So I can just put that, right? And so you understand now?
Yeah.
Okay. All right. Great. So before we move on, I just want you to do B, project B, to see if you understand.
Okay. Question. Why did you put nil for project A?
Okay. Because, okay, if we had added in this amount, you see, it would have been more than the amount, sorry about that, right, it would have been more than the amount that we have borrowed, right? And so we don't have to adding this, so that is a way I just put nil there. Oh yeah, and also
Like,
this just has to be nil as well. Right. So that's why.
For project B, I would put nil for both of them.
Oh yes.
Because they're giving me higher numbers than the 0.8.
Yes. Yeah. Right. Thank you.
Yeah. So what should I be working on now?
Oh, okay. B. I thought that you were doing B. Right. And so the same thing. Right. So I said like in order for me to see if you actually understand, I want you to do B, right? Even though I have the accumulative. Okay. Since I have the accumulative cash flows here already, and they're already subtracted and every single thing. Just tell me how much years it would take for to retrieve the full $28,000.
3.82 years.
Pardon me?
3.82 years.
Not 3.
Oh no, 2.82.
Yes.
Yeah, 2.82. Yeah.
Yes. Okay, good. Right. Okay. And so now for project C.
3.130 years.
Okay. Very good. Very good. All right. So, right. So as you can see, you can still see my slides, right?
Yeah.
Right. So this point is the payback period. And this is just the breakdown of how I have them, right? So as you have said correctly, yes, it is for project B. It is 2.82 years, and for project C, it is 3.130 years. So tell me, which project would you actually don't answer that question. We'll answer that question at a later date, since it's running out of time. We only have 15 more minutes, but yeah. All right, so good. Very good. Okay, so now if possible for next week, I want you to actually work out these questions on your own and see if you actually get back the same answers that I have here, right? And also do it for the payback period as well, right? And if Monday and possible, I know that we had made arrangements last week that Mondays and Fridays are good for you, so that we can getting some additional work, right? So Monday, if possible, we can meet at your available time. We would finish off, or we haven't finished off today. And also I would ask you if you got by the same answers and understood in every single thing, right? Right. Okay. Right. So the next thing that we're going to do is that we're going to look up the criteria for choosing finance. And so remember last week how we have spoken about these different ways of financing. As you said, as we have said before, we can use loans, we can use debentures, which are bonds, government bonds, and also corporate bonds as well. We can also use our personal savings, which can be limited, but still we can still use those, right? So those different types of sources of financing are actually broken down into three categories, right? And so we have short-term financing, medium-term financing, and also long-term financing, which is supposed to be there, right? But I'll add that in at a little. Actually, I'll add that in very quickly now, right? So long-term financing, right? So we are going to look at, first things first, short-term financing, right? Oh dear. Okay. All right. So short-term financing is supposed to only be less than a year, right? Right. So and they're only supposed to be used for day-to-day operations. I am so sorry, I have so much errors. Right. Right. So they're only supposed to be used for day-to-day operations and not anything big or huge, right? And so you would use short-term financing, for example, to buy a piece of machinery, right? And not a building, right? Because as you know, a whole building costs way more than a piece of machinery, right? So it wouldn't work And so a short-term financing would definitely not work for a more long-term project, right? And so the sources of short-term financing is that we can actually have trade credit, right? And if you have actually ever seen a balance sheet or a journal, you would see more so a balance sheet. You would see the word accounts payable, right? It means the same thing as on credit, right? And so what they mean isn't that you are deferring or you are delaying the payment of goods and that you have received from a supplier, and you're paying it at a later date, right? But you do have to be aware that the longer you take to pay it, the more that additional fees are going to be added on, right? Just like how when you have a loan and you don't pay it at the specified date that you're supposed to, then the bank would add on additional charges onto that, right? So late fee charges, right? So we have trade credit, and now we have bank overdrafts. And so with the same bank situation, okay, so do you have a, okay, no, I don't think you do, but for those that use credit cards, right? You know that there is only a certain limit of money that you can use on your credit card, right? However, if you go over that amount that you have access to, it means that the bank is going to charge you, right, for that amount that you have overspent, right? But in order to get that bank overdraft, you and the bank will have to settle a type of I would have to agree that they would allow you to overuse, and then you would pay at a later date, right? So the bank would issue you a bank overdraft, right? So that is what it is. But in terms of for you as a personal individual, you shouldn't do bank overdrafts, and you definitely shouldn't spend more than you actually have, right? Because that can actually put you further in debt, right? So you don't want that, right? Right, so factoring of debt, and this word just means short or medium term, right? I just put that there because it was much easier, but okay, but for your sake and to make it easier so you don't have to go back, right? So short or medium term, and it all depends on the time that is given. Okay, so this is it's actually similar to a bank overdraft, and also kind of like issuing credit cards as well. So Yeah, it's not the same thing, but it's very much similar too. Right? Bank overdrafts. Right? So, yeah. Oh, yes. Right. And also to add on to that, I just remembered. Okay, also, when you have, okay, do you know, like, on credit cards, you're able to pay, like, a small fee, even though you have, like, this huge amount of money, to pay, and there is, like, a high interest rate, even though, and you know that you don't have to spend the full money that and that you have used, but you can actually pay it in like small portions at the end of the month. That is called factoring of debt, right?
Oh,
Kind of
okay.
works similar to a mortgage, but yeah, it's kind of different, but it works very similar to that, right? So that is what is called factoring of debt, right? So we can know, going to medium short term, right? So medium is definitely, it refers to a 1 to 5 years, and it can be sourced in the form of loans, hire purchase. However, hire purchase is only used for like appliances and furniture, right? Most of them, and as you see here, most furniture and appliances, house appliances, in Jamaica, use hire purchase, right? And so if you know hire purchase, right, and if you've also done so in mass, right, you don't have to pay the amount then, the full amount then and there. There's always a deposit, of course, but you don't have to pay that full amount. All you have to do is pay a deposit and then a little bit. You can pay the principal, how much it costs, right, in installments, right, instead of paying the full amount then and there, right? So that can be like in the form of financing as well, right? And then we also have leasing. Instead of buying a whole entire plane, and you may not even have the money need to buy an entire plane, you can actually lease the plane for a lot less money, and pay that lease amount each year, right? Or however long you have to pay it, based on the agreement that you've made between business and also the leasing agency, right? And as you see here, these can be found mainly in the not only in the airplane industry, but also in the real estate industry. But it doesn't only it's not limited to just these two. All right, because sometimes also a leasing can also take place in certain retail stores, especially in hardware stores. Like if you don't have the full amount to buy a whole equipment, you can actually lease that equipment and return it to the store as long as it's in good condition. If it's not, then you have to pay the full price, right? So yeah.
Yeah.
All right. So now we're gonna go down to our final not final slide, but final thing for today. Long-term financing. So, of course, this is something that is over 5 years, right? And it is a use for for our capital projects, and also to buy fixed. Sorry for my shorthand abbreviations, right? Right. So you can use it for to purchase capital projects or purchase fixed assets, right, such as the land and the buildings, right? So the same terminology and that we used earlier, such as shares, venture capital, debentures or bonds, and the same mortgage, and also assistance from the government, all of that can be seen as long-term financing. Right? So since it is now after 6, we're going to end here.